Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Crowdstrike Holdings, ticker CRWD. This is the biggest name in cybersecurity. They are on a pretty big dip right now because there was an incident where between their systems and Windows, there was a pretty large blackout of a lot of systems nationwide, specifically airlines. I know Delta is trying to sue them for damages because they were offline for over a day due to a bug in their system. And the stock's down over 40% on the year. So I want to take a look and see, is it worth picking up? It depends on what kind of investor you are. If you're a value investor, probably not. If you're a growth investor, it's got some potential. So we'll get right into this one. Coming up with a fair value of 111.21. Discounted cash flows 116.27, and current price of 231.69. So clearly it is overvalued right now based on the fundamentals. It's trading at a pretty hefty premium, and I mean, with some of the numbers that we're seeing here, it's kind of reasonable, but we'll decide. Earnings yield almost 2%. We'd want them to come in with the EPS of 11.58, and we're not going to see that for another few years for sure. 3 this year, 4 next year. It's probably a good 3 to 5 years out until we see earnings per share of 11.58. Cash flows look great though. 31.2% this last year, usually around 30.5. So they're holding around that 30 mark, which is very, 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 very good. We like to see it double digits. Up in the 30s is very high. So tells us that they got good margins. Clearly they do have good gross margins, but the net is not good at all. ROE 5.7%, that's pretty bad. ROI is very low, negative 2.4, and ROA about 2. So none of those returns are stellar. We've definitely seen better returns. Debt to equity, 1.87. So that 5.7 return on equity was mediocre, but it's also being skewed because they're heavy on debt. We'd like to see them pay off $2 billion worth of debt or grow their assets by $2 billion. But ideally, this debt to equity is below 1. Margins we've already touched on. 75 is incredible. But if you're coming in with 75% gross, we should see something 20 to 30% net, and we are not seeing that. Actually, we've seen negative net margins. Recently, they've gone positive, coming in at 4%. I think last year they finally started to turn a profit as a company. So we are in the early stages. And if they can turn this around and grow these margins up to 20%, 5x their EPS, then in that case, they're trading at a perfectly fair value right now. It depends on what you think that they're going to be capable of doing. Revenues have had incredible growth, 31% over the past 3 years. Analysts are projecting low 20s going forward, 21.2 and 23.4. So we're going to go with 22 for our thesis. Share count, they have issued shares, slowing down a little bit, 2.6, 1.6. Ideally, they're coming in with 1 or less. In best case scenario, they're buying it back, but it'd be nice if they just stopped issuing shares altogether. Cash flows, 21% growth with a revenue growth of 22%, essentially holds their cash flow yield right where it's at. In 5 years, you're looking at about 30%. On average, they're around 30.5. Assets, huge growth, but slowing down. So we're going to put 20 there. And in a similar vein for liabilities, we're going to put 16 because that's slowing down as well, but with some massive growth. They do not pay a dividend. Their margin, we'd like to see them grow. 10% takes them up to 6.5 over the course of the next 5 years. But, that might not even be reasonable. They might do better than that. I'd like to see them get north of 10% total for their net, which in that case, we're looking at, looks like at least 20% annual growth in their margins. Gives us some crazy returns and makes it pretty reasonable at today's prices, honestly. So with that as our thesis, what we're looking at buying at today's share price, your position is not going to be worth what you're paying for it in 3 years. I mean, the fair value is going to be 25% lower than what you're paying, while the market is up 26%. But if they can continue on this trend for 5 years, then you're getting returns in line with the markets just about. I mean, I guess you're 7% below, so about a year or so's returns below the market. But still, that is probably one of the biggest swings that we've seen, making this one of the biggest growth stocks that we've seen. I don't think we've seen anything else with 30+% average returns. This is one of those stocks it's in its early days. It just went profitable this last year, so it's kind of a gamble that it can pay off very well, or it can really hurt. I mean, you see the swings here. Either you underperform the market by 2x, or you come in line with the market. Personally, that is not a position that I'm willing to take. Now, there are growth stock investors who are likely buying on this dip, but there are definitely better prices. It's been as low as $1 or $140 in this last year. If you bought at that level, I would not be mad buying at that level. I think that'd be a really good time to buy, where in 3 years you're getting returns in line with the markets, essentially. And then in 5 years, you are absolutely crushing almost 3x the market return. So I'd say those people who got in around 140 were definitely intelligent investors. Personally, I'd like to go 120, 110, somewhere in the low hundreds. But that might not happen with a stock like this. The multiple might just be too great for that. And we can put together a worst case scenario too, where we just take some of the lower things that we've seen. 13.5 for the revenue is the lowest that we've seen recently. Their share count, let's say they continue to issue at 2.6. That's the highest. Cash flows, team, assets, we want to take the lowest here. Well, we'll stick with the 20. That's lower than we've seen from them. Liabilities, if they go back up to 32 on that. And margins, let's just say -1. I wouldn't expect those margins to really be eroded too much. If this is the case, something that we have seen realistically within the last 3 years, then it's going to hurt to be an investor here, because I'm currently at the 52-week low, and you're looking at some losses on the 3 and the 5 year basis. If we go to today's price, I would not want to look at my portfolio if I had something like this. I'd buy and then not log in again for another 5 years and hope that things turned out okay. You know, it's still getting decent average returns. It's underperforming the market by a little bit, but nothing too insane. It's not like you're losing out year over year, but you're paying such a premium that subpar market returns are absolutely going to wreck your position. So that's what we're looking at on this one. Personally, I think it's early days and it's a bit of a gamble. Cash flow looks great. Returns, not the best. Margins, gross is incredible. Net has some room to grow. Balance sheet has some room to get fixed as well. So I wouldn't go plowing money into this dip. I'd wait and see. Maybe we can get it down in the low hundreds. And I'd establish a bit of a position there, but there are definitely better opportunities out in the market. Go check out the video that I just did on Louis Vuitton. I think that is one of the best value for the fundamentals that I am currently seeing in the market. And I'm going to be buying up some of that. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.